While foreclosure investigations grab the headlines, forced repurchases of mortgages could be a bigger problem for U.S. banks. Christopher Whalen is managing director and co-founder of research firm Institutional Risk Analytics. His latest book, Inflated, How Money and Debt Built the American Dream, is due to be released in December. He predicts repurchases will put a great deal of pressure on bank income statements. And Chris joins us here on set. Welcome back to Bloomberg. Always good to see you. How much pressure are we talking about?
As much pressure as they took on the credit side. So if you think about loan write-offs, charge-offs that your colleagues were just speaking about, the operational pressure, taking physical possession of properties, having to sell those properties, in some cases having to hold on to them for 2 years before they can get clear title and actually sell them. We're turning our banks into REITs. We're turning them into operators of real estate. And I think Washington has to take a page out of the Depression. We need Jesse Jones. We need either the Reconstruction Finance Corporation or whatever you want to call it.
Is there the political will to do that now?
Not yet. We're working on that. We're a democracy. We're going to need at least 2 elections to clean out the riffraff of both parties. This is a bipartisan problem.
Absolutely.
But the thing I really stress with everybody is it's amusing at times. It's very sad talking about the foreclosure mess. It is a problem. It's going to cost a lot of people money. People that you might not think about, Mark, Bank of New York, custodians, trustees, they're all in the crosshairs now. And then the other thing we have to really think about, big picture, is property taxes. Every time there's a foreclosure, somebody stops paying their property taxes.
Why is that never discussed? You might be one of the few guests on who's actually made the correlation between how a devastation to a neighborhood is devastating in terms of property taxes.
I have been saying for a long time that Barack Obama is walking in Herbert Hoover's shoes, and they are making the same mistakes almost unconsciously. I think it's much the same as it was in the 20s and the 30s. The government then didn't realize what was happening, and I think our leaders are caught in the same problem. When you have foreclosures, what's the next thing going to happen? Not a federal moratorium, not a voluntary moratorium by lenders who can't deal with their backlogs anyway. We're going to have state moratoria the way we did in the 30s, and the governors of those states are going to say, folks, stay in your homes, keep paying your property taxes, default on your mortgage. That's Washington's problem.
Talk to me about then if this is one of those crises that could morph into what we saw a couple of years ago with Lehman. Is it on that scale?
No. You see, you guys in the media have a very tough time. You're looking for events. You're trying to cover the news minute by minute. This is cancer. This isn't a sudden crisis that's going to erupt out of the ground like some monster trying to eat us.
Fair enough.
It's a slow, wasting process. And if we don't understand that that is the nature of deflation and that it's undermining the very foundations of our communities, property taxes, then we're not going to act. You see, we're going to wait till well into this. We're a democracy. We've got to exhaust the alternatives first, and then we're going to do the right thing, which is restructuring.
What does this mean for investors in MBS?
It means they're calling their lawyers. I mean, a lot of mortgage-backed securities, you have a case where the trustee may or may not have a note. Hopefully, let's assume he's actually got a completed note in his files. He still may not be able to foreclose because he may not have clear title to the underlying collateral. Does
this mean that banks are going to be forced to buy back more loans?
Yes, but it also means that there's an awful lot of investors out there who don't know what they own. They may have unsecured debt instead of a fully collateralized piece of paper. And as I say, the litigation is going to go on for years. You have trustees, custodians, all sorts of other agents who are supposed to do things under New York state law. And ironically, very few of the lenders did the right thing. J.P. Morgan was one of the few, in fact. They have some of the best documentation in the industry. But most lenders, even Fannie and Freddie, have issues with that.
So we're talking, this is a case where ownership was not properly transferred.
And I wrote about my own mortgage. My mortgage was originated by Bank of New York. It was sold to Lehman Brothers, who then assigned it to 2 other vehicles before it was securitized. There's no change in the recordation in the New York State courts for that. And this is common. The street was very sloppy. They didn't want to pay that extra half point to send the paralegals around to perfect the collateral lien. But in fact, if you read the servicing documents, it requires that in order for the servicing documents to be active.
Is that what the attorneys general are looking into now?
I think, among other things,
yes. You can't really describe this as minutia. This is basically the letter of the law, letter of an agreement,
New York state law. There was just a ruling regarding Countrywide last week where the judge dismissed it. Judges in that case are basically arbitrators. They're arbitrating a dispute in a contract. But this is a much broader issue than just contract law.
And Chris, you were telling us about your own experience with your own mortgage.
Very common.
And what we were talking about, what it would mean for investors in mortgage-backed securities. How can investors avoid that situation? What should they be looking for? You told me during the commercial break, a lot of people think, you know, I got my mortgage, I'm resting easy.
That's right.
It's not that simple, is it?
Well, no, it's not. You see, most securities issued in the United States are governed by New York law. It's very common. Oldest and most developed body of financial law we have. And under New York state law, there are certain things that have to happen when you set up a trust to issue securities. And one of them is that the dealer has to deliver to the trustee the notes that evidence the obligation. In other words, the borrower borrowed money from the bank to buy their home. You have a note and you have a mortgage. And so if the trustee doesn't have those notes, and if the name of the trustee is not actually inserted in the document in some cases, the contract isn't live. So a lot of investors may hold securities that are in fact uncollateralized. In other words, the trustee may not have the capacity to go out and foreclose on a home to make those bonds money good.
You know, Josh Rosner of Graham Fisher,
dear friend, that's right.
He says potential paperwork errors on some of the $1.34 trillion of securitized home mortgages may give investors an opening to challenge the legality of the data. Are we talking an opening, or are we talking about a chasm?
Well, it's still conceptual, because investors, you'll probably be surprised by this, but they don't have recourse. Most investors have to get at least 25% of a given issue. They then have to go to the trustee and say, Mr. Trustee, we want to reopen this deal, look at the collateral, and potentially sue the dealer who created the deal. That's a very laborious process. It's like any proxy effort. It's very hard to get 25%. So there was just a lawsuit last week that was dismissed on exactly this point. The bottom line is investors don't really have any protections. When you look at mortgage-backed securities, trustees have the least duty of any security you're going to look at.
What's their recourse?
Well, there is none. You see, the trustee is not really your advocate. They're not being paid to serve as an advocate for the bondholders. They're there to do paperwork. That's it. So when you go to the trustee, say you own 25% hypothetically, you still have to pay the trustee to act on your behalf, and you have to indemnify them.
Yes.
If they're going to go off and sue Bank of America or whomever. So the bottom line is investors thought they were safe owning mortgage-backed securities. They said, well, agency paper. But the paperwork was not done, and there may not, in fact, be any collateral underneath these securities.
And Chris, I'm so sorry we're going to leave it there, but we're going to have you back soon, because this is a fascinating diagram of what's been going on right now.
Yes, it is. A very sad one.
Yes, very much so. Chris Whalen, Institutional Risk Analytics. Thanks so much for coming.
My pleasure, Mark.
Always good to have you on. Thank you.